Hi, everybody. This is Gary Dean, and this is our nightly video report for Tuesday, March 29th, 2016. So the markets moved up today. The algorithms are pretty much programmed to take any kind of dovish talk from Yellen today and really grind things higher. I think it has a lot to do with where we're coming towards the end of the month and the end of the quarter, and they really want to try to hold things up so when they send their statements out to their people, they can say, see, you're back to even again. So that's one reason. But, you know, a couple things I see playing out right now are just going on is, you know, each move that the bulls have done has really been off of some type of central bank talk, whether it be the ECB, whether it be the Bank of Japan, whether it be us not doing anything. So, you know, these central bank moves, they suck being on the wrong side of it. But the thing is that they're like rocket ships. They go up quick and then they come back down again. So today was really nothing. I don't know what they were all kind of happy about. We're really the same place we were yesterday as far as business as usual. I don't think anybody was really anticipating that Yellen was going to raise rates next month, but they did. We were surprised, and the algorithms pushed it higher. And what I'm seeing is a lot of bears are just outright frustrated right now, and ready to give up and already looking at new highs. And typically, when the moves happen to the downside, there's nobody ready for it, and this seems to be following suit. So first thing we're looking at, you can see money flow. Spiders was the number one as far as selling the rally. We had money flow almost negative 80. The total block trades minus 90, so it was in the number one spot. So we know big boys were selling this rally. If we take a look at our regular charts, the Dow Jones now has some bearish divergences, very overbought on the daily chart. One thing that I think I've been saying is that they may want to get the Dow up to the 17,727, which is not really that far away, only 90 points, because that's a 78% retracement, and this is where the S&P already is. We're already at the 78% retracement. So we have bearish divergences that are now extending on the S&P. We haven't really had any kind of price reaction. But I'm going to show you something that, on the 60-minute chart. But the one thing I want to just point out is that, these aren't the situations that you want to believe we're in some kind of QE program where we had these nonstop moves going. This is where there is no QE, and people are just hoping she's not going to raise rates. So you're not going to get your buy-in from the everyday people like we had for the past 6 years. This is more, okay, we getting these jolts, but right now we're right back to where we were on the 22nd, and yet this move right here has really deflated so many of the bears' balloons right now that they're just outright frustrated. So any kind of break, most likely they're going to cover, and when they're out, that is when typically we're going to fall. But these bearish divergences, they're everybody was saying the same thing when we were heading up here, that we're taking out the 2135, and we had the bearish divergences. We knew that things weren't going to continue up, and from there we had the big move down. So if we look at a 60-minute chart, I have these little circles here. This is what I call the bear just outright frustration phase. When we get a drop, it seems like, okay, the top is in and we're going to drop down, but what happens is they bring it back up. All the bears cover because they assume we're taking out the highs, or we take out the highs marginally, but once they're all out, that is when we have the drop. So a lot of people, including myself, I was giving it a 50-50 shot that this was the top, and I said that they may come back and test it or even break it a little bit. Well, here we are. This is the frustrating part of the bears, but we're right back to where we were. There's no, so if we break up, we're going to get some, some bears that are going to cover, and that's going to leave the door open for the real drop. But momentum really is not going to pick up on the bearish side until we take out these lows at the 2017. So the first really line in the sand, I think the earliest clue is going to be if we can see a push below the 2042 level. But also just look at these strings of bearish divergences here, and we've not had any clean, really, to say, retracement that has refueled the tank. Everything's only gone to the the midline here and then started heading up. So one thing that I kind of mentioned in the trading room was, you have a rocket that keeps hitting the fuel injectors when it's up in the air already. It doesn't move as fast, and when it comes off the ground, like it was a takeoff, like something like I don't know what's going on here. Okay, so something like this, yes, you get these rocket moves and they go, but you can see when they hit the fuel button to get it up higher, they just start getting limited action off of that, and eventually they run out of fuel and we head down, and that really has not changed. And until they take out these highs, we are still having lower lows and lower highs, and everything else in between this is just noise and people predicting that we're making new all-time highs, or we're going to continue up, or we're going to make a new bear market. Right now it's noise until this high is taken out or this low is taken out, and it's a really is considered a bear market until then, because we've had a string of lower lows and lower highs. So anyway, we've seen these moves where they come back up and test it or break the highs. This could be one. We will find out soon enough. But really, until the bears can push it through this 2017, that's going to be when we know things are, really starting to going to start picking up momentum on the downside. If they head higher, we could see them make a run someplace up to the 2066, possibly to 2070. But again, from the 2057 highs that we were at, that's not that much higher, and it's more just pain because of the time part of it. So anyway, that's pretty much it on there. An early clue that, like I said, that things are going to start breaking down would be a push through that 2043. From there, we should get a test of the 2022 or 2017, and then from there down to the 2007 level. But we really haven't had any kind of breathers during this run. This is a typical bullish move, and it's still a counter trend move within a downtrending market until that 2117 is taken out. And it doesn't really make a difference what moving averages or above or whatever. It has to take out that 2117. Until then, even your major technical analyst people will be saying the same thing. We're in a downtrend until the 2117 is taken out. And to me, this is just more frustration. I do believe we roll over. When, it could happen any day. Maybe they drag it out until Friday. We'll have to wait and see. But I see a lot of the bears getting very, very frustrated. And just, on a bigger view, I do believe that there's, not going to be any issue being short, because I think that it's going to run its course and then head back down again. So with that, until we see what plays out tomorrow, have a great night, and I'll see you guys in the morning.